long-term care is not free.
One of the things that make it tough for planning is we don't really know if you're going to have a scenario where you have some higher expenses.
They don't really tell us the truth. We have to talk about it with every client now.
I think a lot of times people think we're automatically going to insurance. So instead of using insurance to fund the long-term care expenses, you could use...
Hello and welcome back to another episode. As always, my co-host, Joseph, and today we're talking about something maybe that I don't think we've spoken too much about in depth in the past, but definitely is going to be on the minds of many Canadians who are in retirement or entering into retirement, and that would be long-term healthcare and the effects of it, and also kind of how to have discussions around it and plan around it in your retirement plan.
Yeah, so I think, and we were talking about this before, Regan, but one of the things that I like to tell people is, like, you don't have to have insurance necessarily for this, but we do want to make sure we have some kind of a plan. We've thought out about how we will handle these potentially high expenses later on in life, right? And one of the things that make it tough for planning is we don't really know if you're going to have a scenario where you have some higher expenses. But if we look at some of the research around retirement spending, we have the retirement expense smile, right? So we spend a lot more money early on in retirement because we're excited, maybe want to do more travel, we're still pretty active, and we could call that the go-go years, and then we kind of move into the slow-go years when we're maybe 75 to 85, just depending on health. But and in that scenario, maybe we're able to do some of these things, but we just don't really want to get out and go as much, right? So we're spending less money, and then we have the no-go years where really we're just not spending on anything other than kind of the necessities. And for some people, that's it. But where the smile comes in is those expenses could rise later on if we have some kind of health issues that we need to deal with in the terms of like long-term care, right? Yeah. So how are we going to make sure those things are taken care of the way we would want to have them taken care of if that arises?
Yeah, absolutely. Yeah. I think it's important for people, if they don't know, or if you don't know, is that long-term care is not free, essentially, in Canada.
Yeah, exactly. There are some expenses there. There are potentially some subsidies, but I know that for our clients, most of them want to make sure that if they ever ended up in a nursing home, for example, that they have a private room, for example, right? Yep. And so there's no subsidies for private rooms. Like, you have to pay the price of the private room. So could definitely be some expenses there. So there's, typically three ways we might, fund those expenses into the future, which could be built into the planning. So the first one, which is actually, I don't know about you, Regan, but for me, it's the least common, is actually insurance or long-term care insurance. And I think that's the same for you, right? Kind of the least common way of...
Yeah, it is. Yeah. Nobody, I had one client that did have it, but then he questioned if he needed it, and it was a small amount. I think it was like, the benefit would have been like $450, $500 a month, something like that. So the actual, like, what that would actually mean for him if he did have to claim on, or if he did have to claim on the policy, it was irrelevant almost. It wouldn't have made a difference in his world.
Yeah. So for most people, what typically happens is the people who need it can't afford it, and the people who can afford it probably don't need it. So
that's just about it.
Right. Yeah. So then that kind of pushes us on to our next two options. So one is maybe just through your investments and your saving, the way you plan for your whole retirement. Or maybe you're fortunate enough to have pensions that might take care of it, but it's funding it through your investments and your savings. So just making sure that you're not going to deplete your savings too early, which again goes back to the planning piece. And then the other piece, which we've probably mentioned this on the show before, Regan, but is thinking about that home equity as a bit of an insurance policy in itself, right? So the way I think about that with clients, or a lot of clients will ask, well, we could maybe supplement our spending out of our home equity, which is possible, right, when we're thinking about retirement income planning. But I really try to, for most people, again, depending on the situation, think of that as like our insurance policy. So what if there are these unexpected expenses like healthcare in the future that we just weren't able to properly plan for? We know we always have that to fall back on.
Yeah. Which is typically what's going to happen in like the most probable thing to happen in most cases is that you get to a certain point where you're at least going to be downsizing. You don't want the maintenance or the maintenance of your property in the future. And so the likelihood of you downsizing is probably greater than not. Again, it depends on the circumstance, and or a lot of times people, they don't even want to have home ownership, so they might sell and then rent in the future. So I would agree with you that that's a good way to look at it and approach it.
Yeah, and then there's other things we could also be doing or thinking about as far as planning on staying in our home if we do want to keep the home, and that's just thinking about what can we do to make the house more accessible, right? So as we age, if we want to age in place, like when we're doing our renovations, should we be putting a new tub in, or should we be thinking about a more accessible shower that we're going to be able to
Right. Yeah.
use as we age, as an example?
Yeah. Yeah.
Um, and then I guess the other thoughts are, some of this is not financial, right? Some of it is just
Mhm.
having the conversation with kids about, our expectations and what we want to see happen, and getting those other pieces, important pieces in place, like our powers of attorney for health
Mhm.
and for property, so that
Mhm.
we know who's going to help make those decisions if we're not able to. And also having trusted contacts in place, which I know we were just talking about, Regan. Both of us have our trusted contacts in place for our investment accounts. Maybe you could just talk a little bit about what that is.
Yeah. So a trusted contact, we have to talk about it with every client now. Like it's a regulatory thing at this point in time, where it never was. It was usually reserved for people who were aging. It was the idea, but now they would like us to bring it, to ask every single client if they would like a trusted contact. So a trusted contact, this individual basically is somebody that we could call in the event, and we, the advisor, could call this person in the event of us being concerned about the financial decisions that the client is making. So a good example of this is a client calls us up and says, "I want to make a redemption of $10,000," whatever the case may be, and we know that this is not part of their plan, if you will. We know that they have good cash flow. We know that, they're shit unless something came up, they they may not necessarily need that $10,000, but when we ask about it, they don't give us the information. They guard they how do I wanna say it? They don't really tell us the truth, let's say, and they feel like it has to be done really quick or something like this, where now, so maybe Joseph or I feel suspicious, we could call that trusted contact and just say, "Hey, Mr. or Mrs. Trusted Contact, I feel like a meeting is warranted between me, you, and the client. Could you please get that in motion, if you will?" Right? The trusted contact does not have, they're not a power of attorney.
No.
They can't give directions to Joseph or myself as far as like action items to do on the account. Like they can't give us instructions to sell money and or sell investments to cash or anything like that. It's just purely a trusted contact.
Yeah, exactly.
Yeah.
And then when we think about estate planning, we always talk about getting our will in place, and we mentioned POAs, but
Mhm.
POAs, just as a reminder, powers of attorney, those are for while you're still living, right? And you're unable to make those decisions for yourself around property. So one, like, what is happening with your investments? How are you paying the bills? All that kind of
Mhm.
stuff. And then the other piece is who's making those healthcare decisions for you if you're unable to. And so
Mhm.
one thing I find, most people have a will in place when we talk to them. It might be outdated, but they have one in place. But what I do find is,
Mhm.
for the ones, which are many, that are outdated, is depending on how long ago they put them in place, they may not have done their powers of attorney. So they think they have their estate
Mhm.
planning documents done, but it turns out they have an outdated will and no powers of attorney in place. So it's something
Mhm.
that I encourage people to make sure that you actually have all the documents. So two powers of attorney and the will in place.
Yeah. Which it's always good to, I know people don't like to, if they've done a will in the past, to do it again. They don't really wanna do it, but for what the cost is and what that document supports, it's a very important, um, piece of your retirement plan or your overall, life plan.
Yeah, 100%. So I
Yeah.
guess kind of short and sweet, Regan, but just to wrap it up, the idea here that we're talking about, long-term care planning,
Yeah.
long-term care health type issues, is really just making sure that you've thought about what that might look for you into the future, and you've had those conversations with your kids, and you've put
Yeah.
into place some of those important pieces, which is not necessarily insurance. So I think a lot of times people think we're automatically going to insurance,
Yeah. Yeah,
but it's
exactly.
not what it's about. It's just about making sure that there's been some planning put in
Yeah,
place.
and you can always do worst case scenario if you have a proper plan, retirement plan in place, let's say, and you're working with an advisor who's a planner, it's easy enough just to run the scenario of at age fill in the blank, you require long-term health care and it cost fill in the blank and it's going to run for a number of years. And then in that scenario, maybe you sell your house to fund it and the proceeds from the house gets invested into a non-registered account or whatever the case may be. And you take out X amount per month and so on and so forth, and just adjust your cost of living in those scenarios. You could find out, I guess, how your plan holds up, right? And just doing a quick stress test on that to see if you're still in the money, if you will, and that could give you a lot of peace of mind,
Yeah, essentially.
essentially.
For sure. And I know a lot of the people listening, a lot of our clients like that, they're going to be fine when they run those scenarios, right? And so the potential risk you run of having higher than expected expenses is depending on if legacy goals are important to you, right?
Yeah.
So
Right.
another
Yeah.
way of using insurance potentially is if you say, you know what, I don't want to use my home equity because I want to make sure my kids at least get my house. Like I want to make sure I leave something
Hmm.
to them. So
Right.
another way to make sure that that legacy is left behind is you could use life insurance for that, right? So instead of using
Yeah.
insurance to fund the long-term care expenses, you could use life
Mhm.
insurance to just guarantee that legacy gift that you want to leave. And for lots of people, that's not important and that's fine. But it's just like if that is something that, and listening to us talk about how we might pay for that, if that's something that worries you, that would
Mhm.
be another way to potentially safeguard that goal.
Yeah. Yeah, for sure. Yeah. Yeah. And or if you had a policy that like a permanent policy, so whole life or universal life policy that maybe you had it for a long time and it has a decent cash surrender value position, maybe using some of the funds from the CSV portion of those policies to fund long-term healthcare could be a viable option as well.
Yeah. So, and kind of what you're saying there, Regan, is if you have a cash surrender value in one of those policies, you could
Right.
access that cash. So
Option.
probably the kind of like your home, you could use it as security and borrow against it so that
Yeah.
you get access to that cash right away. You pay no tax. And then when you pass away, the life insurance death benefit will take care of the loan, right?
Of long and usually leave some behind as well,
Yeah.
in most cases, but yeah, that's another option I guess you could look at, but I guess either which way, me again, you run those scenarios, most people are probably gonna be, in a good position.
Yep. You got it. All right.
Yeah.
Anything to add,
Perfect.
Regan?
No, I think we can, wrap that up here. I know you got another meeting to head to, so, yeah, no, it's good chat, and thanks for joining again, and, to all our listeners, thank you for listening or watching today. We'll
Yes.
talk to you guys soon.
All right. Thanks, everyone.